Section 3. Currency Contracts. Currency futures and forwards are widely used to hedge against the risk exposure to exchange rates. Many corporations use these contracts for short-term hedging. For example, a US importer of game consoles has an obligation to pay the Chinese manufacturer 100,000 RMB 90 days from now. Thus, the importer bears exchange risk due to the payable being denominated in RMB. By taking a long position in a forward or futures contract to purchase 100,000 RMB 90 days from now, the importer locks in the exchange rate. In this section, we will focus on two currency contracts, the currency prepaid forward and the currency futures. First, let's introduce the currency prepaid forward. Suppose a Singaporean wants to acquire $1 T years from now. A prepaid forward requires him to pay Singapore dollars today for the delivery of $1 to him T years from now. Can you determine the prepaid forward price? Let F0 with superscript P denote the prepaid forward price in Singapore dollars. Working backward, we have that $1 T years from now is worth $1 times the discount factor between time 0 and time t, based on the US interest rate RU. Let X0 be the time 0 exchange rate for Singapore dollar per $1. We then obtain the prepaid forward price in Singapore dollars. Obviously, the prepaid forward price is the current Singapore dollar cost of obtaining $1 T years from now. Thus, to obtain the forward price, we simply compute the future value using the Singapore-based interest rate RS for T years maturity. More precisely, the forward price F0 is equal to the prepaid forward price divided by the discount factor from time 0 to time t, based on the interest rate RS. Substituting in the expression for the prepaid forward price obtained earlier, the forward price F0 can be expressed in terms of the current exchange rate X0 and the discount factors based on the interest rates RU and RS. Therefore, F0 is essentially the forward exchange rate. From the above expression, it is easy to see that F0 will exceed the current exchange rate X0 if the domestic interest rate RS is higher than the foreign exchange rate RU. Conversely, F0 will lag the current exchange rate X0 if the domestic interest rate is lower than the foreign interest rate. Now let's take a look at an example. Suppose that the spot exchange rate is 1.3788 Singapore dollars per $1, and for half a year maturity, the US-based interest rate is 0.25%, and that of the Singapore-based is 0.75%. Both rates are continuously compounded. Given the above information, can you determine the forward price for a currency forward contract for a Singaporean investor to acquire US dollars half a year from now? This is essentially to determine the forward exchange rate. Using the formula derived in the previous slides, we can get the forward price per $1 as follows. Here's a remark. A long position in a currency forward can be replicated by borrowing in the local currency and lending in the foreign currency. For the example given earlier, the long position can be replicated by performing the following steps at time 0. First, borrow Singapore dollars at the interest rate RS. Second, convert the Singapore dollars to US dollars at the exchange rate X0. Finally, invest the US dollars in the US dollar interest rate market for a period of T years to earn interest at rate RU. At the maturity time T, we repay the Singapore dollar loan and get back the US dollar investment. This is equivalent to holding a long position of the currency forward at time 0. Next, let's talk about currency futures. As at January 2016, Chicago Mercantile Exchange offers 59 foreign exchange futures, with 19 being non-US dollar cross-rate pairs, to serve as an effective and efficient means of risk transfer for the global foreign exchange market. A total of 23 currencies are covered in these futures contracts. The foreign exchange futures contract is named following the currency pair convention, the base currency over the terms currency. For example, the AUD over USD futures contract has the Australian dollar as the base currency and the US dollar as the terms currency, or the quoted currency. Each contract is for 100,000 Australian dollars, and the price is given in amount of the US dollars per 1 Australian dollar. Here's another example. The Chicago Mercantile Exchange has two Chinese renminbi-based contracts, the Chinese Yuan USD futures and the Chinese Yuan Euro futures. The contract size is 1 million renminbi for both contracts, with price denomination in US dollar and euro respectively. These contracts are cash settled on expiration in US dollar and euro respectively. More information of these foreign exchange futures or options can be found in the product guide at the website of the Chicago Mercantile Exchange Group. This is the screenshot of the final settlements for the Chinese renminbi over US dollar futures at the end of February 12, 2016. Now, suppose a US importer has an obligation to pay 3 million renminbi in June 2016 for a delivery of mobile devices. The delivery date is 13th of June, which happens to be the expiry date of the June 2016 Chinese Yuan USD futures contracts. On February 12, 2016, the importer decides to hedge its currency risk by setting up a long hedge with 3 June 2016 Chinese Yuan US dollar contracts. If the last trade in the table on the previous slides were executed by the importer, then the locked-in exchange rate is 0.151280 US dollar to 1 Chinese renminbi. Up to now, we have finished the section on currency forward and futures contracts. And that is the end of this chapter. Next lesson, we're going to study options.